Alright you guys, so I'm just going to make this video really quick about how we open up spreads, and we'll go into just slightly what spreads are and why we're going to use them as well. First things first, we're going to open our option chain, and you're going to start off probably with something like this. I usually like to expand it a little bit more, around 35 or 40 strikes, so you can get a good picture of everything. And we're actually going to be going for this trade that I'm eyeing up for XOP, which is oil and gas exploration and like basically producers of oil. So we're going to look to play a bullish position on this, and we're going to go actually for May 20th monthly expirations. When you have this open, you're going to see that it just says single at the top here for spread. And what we can do is actually click on vertical, and this is going to give us a single strike vertical spread. So this is basically us buying and selling the corresponding strikes. So we're going to be buying the strike that's at the money and selling the strike that's slightly out of the money for the calls. So basically with this, we want to actually make our spread a little bit wider. And so what we'll do is go down to deep and wide, and then we want it to be in the same month, and we want the strike to be 3 strikes for this particular trade. And we want this to be vertical, just like this is vertical here. We want this to be vertical here. And then now you see that the strike is actually three strikes away. And so this is the contract that I'm thinking about getting. Still haven't decided if I'm gonna get it yet, but I'm just making this video really quick. Here's one way to open it: is you can go in and actually click on the contract here. Basically, the way that this works with the vertical spread is you're buying a call, and then you're selling a call that's a little bit further out of the money. And what that does is it reduces the risk of the trade. It also reduces the premium you pay, because when you sell a contract, you're collecting premium, and so part of that proceeds of you collecting premium goes towards the actual purchase of this contract. So if we go back and we look at single and we look at 140, this is $8, but since we're going with the 155 strike to sell, we're actually selling this for $3.30, and we're buying this for $8.15. And so the difference here is about $4.80 or so. And so if we go back and look at the vertical spread here on the deep and wide for 3 strikes away, you can see that that's pretty accurate. That's the right in the middle of these two prices here. So that was an accurate estimate that I made. And that's just to show you and reiterate that we're buying the 140 and we're selling the 155 here. And this is called the debit spread, and this is a bullish position, and it acts really similarly to just buying the 140 contract straight up, except now we have kind of an upper price limit and also reduced leverage on the trade, because as the stock goes up, our contract that we sold will actually gain value, and so when we buy the contract back, we'll lose money on the short position. But that's okay, because the long position, it offsets the other contract because it's closer to at the money, and then at the time of the sale of the spread, we're actually deeper in the money with the 140 contract. So the 140 would be somewhere in here, and then the 150 would be right here. So then it would be still the same kind of dynamic, except you would have to look at the singles to see the price appreciation here. But yeah, anyway, I hope that makes sense. I know it's a confusing topic, and I'm really just kind of jumping into it here just to show you guys how to enter the trade that I might call out. If you guys have questions, go ahead and ask, but I'll make a little bit longer video explaining spreads in the near future. So thanks again for watching.